Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for May 6th, 2018. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 0.77 declined from 0.90 last week, continuing in bearish territory. The total count of securities in bullish or bearish patterns increased 2% to 2,796. The count of bearish stocks increased 9%, while the count of stocks in bullish patterns decreased 7%. The Pirls PNF market breadth summary chart shows us a market now 2 weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 48 points for the second decline in 4 weeks. At a negative 13.69 points, it continues below all 9 tops above plus 100 in the last 30 months, and continues above all 5 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. The CCI 20 daily at positive 48.02 is up from positive 35.03 last week. At Friday 5/4 close, the CCI 20 daily pivoted from about a negative 44 at Thursday 5/3 close, forming a zero line reject long entry signal within the plus or minus 50 range, rising to a positive 48.02 at Friday 5/4 close for a long entry signal at Monday 5/7 open. We will continue following this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 105 weeks ago, while the daily CCI 20 began a Woody's uptrend 2 weeks ago. The CCI 20 weekly rose to a negative 14.24 from a negative 34.95 last week, within the plus or minus 50 range required for a valid zero-line reject long entry signal, but rising less sharply than it fell the prior week. So we decline the otherwise valid Woody's uptrend long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: REITs, some tech, and S&P retail on top. Some tech, brokers, and KBW Bank on the bottom. Bullish S&P Retail continues in the top 5. Semis has left the bottom 5. REITs has entered the top 5. Computer hardware, comp tech, and semis have entered the top 5. Oil and oil services have left the top 5. Disk drives and computer hardware have left the bottom 5. Bearish, networkers, brokers, and KBW Bank have entered the bottom 5. Focus this week from www.zerohedge.com. That link has been broken. Morgan Stanley makes a stunning claim about China's credit impulse. The following are some key points. 1 year ago, in June 2017, we wrote, quote, "Why the collapsing global credit impulse is all that matters," end quote, in which we explained that among the relentless barrage of economic data, the only indicator that truly matters for global macro was how much credit China, which has been responsible for the bulk of global debt creation since the financial crisis, is unleashing upon the world at any given moment, the so-called Chinese credit impulse. Today, in its weekly Sunday start piece titled, quote, "Don't fear China's policy tightening," end quote, Morgan Stanley follows up on this observation with its chief Asia economist, Chetan Iyer, confirming that, quote, "If you had been able to reliably pick the key global macro variable over 2012-2016, China's credit impulse would have been your choice," end quote, and explains why this should be obvious to readers. The incredibly tight link between the credit impulse and China's growth cycle, emerging markets exports, global growth, and commodity prices meant that it would have accurately predicted the direction of almost all other global macro variables that mattered, with about 6 months lead time. He further explains the simple, in retrospect of course, reason behind this observation. China's credit impulse, or its leverage cycle, was the only game in town back then. With global aggregate demand weak as developed markets were deleveraging and EMs were adjusting, the change in China's credit impulse was the most significant driver of the global economy. However, in a striking claim which breaks with precedent and which, if correct, suggests a historic change in the relationship between China's credit creation and its impact on global markets and economies, the Morgan Stanley economist then writes that the link between China's credit impulse and the global economy, quote, "has now been broken," end quote, and justifies his answer as follows. China's tightening has not had a material impact on the growth cycle either in China or globally, even though its credit impulse began to weaken about 24 months ago. As deleveraging and adjustment headwinds recede, the recoveries in domestic demand in both DMs and EMs have emerged as additional global growth engines. Morgan Stanley gives the following explanation as to why China's credit tightening may no longer be a global factor. Why hasn't the tightening in China had a material impact on its growth trajectory? We see 2 reasons. 1, the pace of tightening is gradual and flexible in this cycle. Over the past 24 months, tightening in China has been slower than in 2013-2015, and the pace of future tightening isn't on autopilot. 2, tightening in China is counter-cyclical this time. while we appreciate Morgan Stanley's attempt at overhauling Austrian economics, we agree with the conclusions because when push comes to shove, it's still all about credit creation and, as we showed recently, China's credit impulse works with a very distinct lag. As for the best argument why Morgan Stanley is wrong, we will defer to what BOFA's Michael Hartnett also just wrote this morning, noting that, quote, global central banks just eased, led by the PBOC, reminding everyone that on April 17th, China surprised with an easing of monetary policy, end quote, which incidentally has been the trigger for the most important move of the past month, the relentless U.S. dollar strength. In other words, just as the global slowdown from the ongoing Chinese credit impulse is finally being felt, China does what it has done every time global growth hit a brick wall. It has resumed easing in hopes of sending the country's credit impulse back into positive territory, re-stimulating global growth in the process. So, no, Morgan Stanley, the Chinese credit impulse link is most certainly not broken. And as for your advice to, quote, not fear China's policy tightening, end quote, that may have been warranted 6 months ago. However, now that China is once again easing, you may want to reassess. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.